Welcome back, everyone. OG John AG is here. Before we look at silver, gold, oil, the Fed, China, Iran, or what happened in the markets on Friday, I need you to understand one thing clearly. Friday was not just a silver crash. Friday was a warning shot across the entire financial system. Silver dropped more than 10% in a single session. Almost $10 disappeared in one trading day. Gold fell. Treasury yields jumped to a one-year high. The dollar strengthened. Mining stocks were crushed. Consumer sentiment hit the lowest level ever recorded. Inflation came in hotter than expected, and the market suddenly realized something very uncomfortable. The rate cut story that investors were believing only 2 weeks ago may now be dead. But here is the contradiction. While paper silver collapsed, almost every structural reason to own physical silver became stronger. That is what tonight's video is about. This is not about hype. This is not about fear. This is about the difference between a panic in the paper market and pressure building underneath the physical market. And before we go deeper, I owe everyone watching the source code a quick moment of honesty. For almost 2 years, the deal on this channel was simple. The work was free. The data was free. The research was free. I never wanted to ask this audience for money, but YouTube's recent policy changes have made running this channel the old way almost impossible. The advertising side has weakened. The monetization side has weakened. The platform support that used to pay for the hours of research behind every video is no longer what it used to be. So I am asking only once and only as a humble request. Please consider supporting the source code on Patreon. The link is in the description. It is $20 a month. I know that is not a small amount, and I am not pretending it is. Every script here takes hours of live data checks, primary source verification, central bank releases, exchange filings, vault reports, analyst commentary, and market cross-checking. The cost of running this desk has not changed. The income side has. If even a small group of you can help, you keep this work alive. If you cannot help right now, you are still welcome here. The data will still be free. The research will still be shared. Now let's get into what actually happened. By the close of Friday, May 15th, 2026, spot silver was trading around $77.52 per ounce. That was down about $9.21 on the day, a fall of more than 10.5% in one trading session. Gold closed near $4,564 per ounce, down about 1.83%. The gold to silver ratio widened sharply to around 58.9 after sitting near 53.6 only 24 hours earlier. That move matters because it shows silver was hit much harder than gold. Silver had already peaked intraday earlier in the week near $88 per ounce. Then the inflation data hit, the bond market moved, the dollar firmed, and the unwind began. Even after the crash, silver was still up over the trailing 30 days and massively higher over the trailing 12 months. But the short-term damage was real. The January 29th intraday high near 121.67 now sits roughly 36% above current spot silver. That means the market is no longer trading like a simple runaway bull market. It is trading like a stressed market caught between two forces, strong physical fundamentals underneath and aggressive macro pressure from above. And that is the key. This was not just silver falling by itself. This was a cross-market event. Precious metals fell. Mining shares fell. Government bonds sold off. Yields rose. The dollar strengthened. Energy stayed under pressure because of the war risk premium. That synchronization tells us silver was not reacting only to silver news. It was reacting to the entire macro machine. So what cracked the market? The answer begins with inflation. On Tuesday, May 12th, the Bureau of Labor Statistics released the April Consumer Price Index. Headline CPI came in at 3.8% year over year, above expectations and the highest reading since May 2023. Core CPI, excluding food and energy, printed at 2.8% year over year. That was only the first hit. The next day, Wednesday, May 13th, the April Producer Price Index came out. Final demand PPI jumped 1.4% month over month against expectations near 0.4%. That was the largest monthly wholesale price increase since March 2022. On a year-over-year basis, PPI hit 6.0%, the highest since December 2022. Core PPI rose 1.0% month over month and 5.2% year over year. That is not a small miss. That is a full repricing event. And the details were even more important. Nearly 60% of the April increase came from final demand services. That matters because services inflation is exactly the sticky category the Federal Reserve watches closely. Goods prices can swing. Energy prices can spike and fall. But services inflation is harder to kill once it takes root. In simple language, producers are paying more before products ever reach consumers. And if those costs keep moving through the system, consumer inflation may stay hotter for longer. The market understood that immediately. Only 2 weeks earlier, traders were still pricing in the possibility of 2 Fed rate cuts in 2026. 1 week earlier, the probability of a rate hike by December was only around 16%. After the CPI and PPI reports, that changed fast. By Friday, the market was assigning almost zero probability to a 2026 Fed rate cut, while the probability of a rate hike by December had climbed to around 50%. That is a massive shift in only 7 days. And that is what hit silver. Silver does not pay a yield. Gold does not pay a yield. When Treasury yields rise and the market expects tighter monetary policy, the opportunity cost of holding precious metals rises. That does not mean the long-term silver story is dead. It means the short-term pressure becomes much stronger. Then another major development landed on top of that inflation shock. Kevin Warsh was confirmed as the new Federal Reserve Chair on May 13th. The Senate vote was 54 to 45, the slimmest confirmation margin ever recorded for a Federal Reserve Chair. Only Senator John Fetterman crossed party lines. Jerome Powell, the outgoing chair, will remain on the Board of Governors through January 2028. That creates a strange two-chair dynamic. The new chair is in power, but the old chair is still sitting inside the system as a structural check. Warsh's first Federal Open Market Committee meeting as chair is scheduled for June 16th and 17th. That meeting matters because it includes the updated dot plot. The last dot plot still showed at least 1 quarter-point rate cut for 2026. But if the June dot plot removes that cut completely or even begins to show a possible hike, silver could remain under pressure through the third quarter and possibly into the fourth. Warsh also has a hawkish public record. During his previous time as a Fed governor, he opposed quantitative easing when the balance sheet first crossed $4 trillion. He also called for regime change at the central bank. So now the market is looking at a new hawkish Fed chair, the hottest inflation data in years, rising Treasury yields, a stronger dollar, and a dot plot coming in June that could remove the last piece of the rate cut story. That is why silver crashed on Friday. But the story does not stop there. At the same time, President Trump was in Beijing for the first United States presidential state visit to China in nearly 9 years. The market had hoped the summit might deliver some kind of pressure release, maybe progress on trade, maybe clarity on rare earths, maybe some movement on Iran, maybe a signal on semiconductor flows. Instead, the summit ended with only one major announced trade deliverable, China's commitment to order 200 Boeing aircraft. A reciprocal visit by Xi Jinping to the United States is planned for the fall, but there was no major breakthrough on the issues the market actually cared about. Taiwan remained a major tension point. Rare earth export controls remained unresolved. Semiconductor concerns around Nexperia remained unresolved. The fentanyl precursor issue remained unresolved. And no concrete public agreement came from Beijing on Iran mediation. So the market did not get the geopolitical relief it wanted. China still holds major leverage in rare earths. China still holds leverage through semiconductor supply chains. China still has influence over physical silver inventory. And the United States left Beijing with the same inflation problem it had before the summit. That inflation problem is being fed directly by energy. The Iran war and the operational closure of the Strait of Hormuz remain central to the current inflation shock. West Texas Intermediate July futures pushed above $113 per barrel on Friday, on track for a weekly gain of around 10%. Brent crude traded above $106 per barrel, also sharply higher for the week. Trump described the latest Iranian peace proposal as a piece of garbage and warned that Iran could face annihilation if no deal was reached. That kind of language does not calm energy markets. Crude and fuel flows through the Strait of Hormuz have dropped sharply. Some estimates show a decline of around 4 million barrels per day in March and April, with earlier peak estimates closer to 6 million barrels per day. Normal shipping through the strait has not returned. Around 30 vessels reportedly crossed after Wednesday evening, but before the war, about 140 ships typically moved through each day. Saudi Arabia has also informed OPEC that its oil production has dropped to the lowest level since 1990. That matters because energy is not just another commodity. Energy touches everything. Transport, food, manufacturing, mining, logistics, household bills, industrial production. If oil stays high, inflation pressure stays alive. That is the chain. The Strait of Hormuz shock pushes oil higher. Higher oil feeds inflation. Hot inflation pushes the Fed more hawkish. A hawkish Fed lifts yields. Higher yields pressure silver. That is the direct line from geopolitics to the silver crash. Now let's look underneath the paper market. London matters because London is where the largest pool of physical silver in the world sits. At the end of April 2026, the LBMA Loco London Vault system held about 27,454 tons of silver. That was slightly lower than the prior month and equal to roughly 882.66 million ounces. Compared with the all-time peak of 34,346 tons in January 2021, the London silver pool has drained by roughly 7,000 tons over 5 years. That physical drain did not suddenly reverse because silver fell on Friday. The paper price crashed. The vault trend did not. Mining equities were also hit hard. Fresnillo, the largest pure-play silver miner on the FTSE 100, fell about 9% in a single session. Anglo-American dropped more than 6%. Hochschild Mining fell around 6.4%. Endeavor Mining lost around 6.6%. Antofagasta fell around 3.7%. The mining complex dragged the broader FTSE 100 lower. That makes sense because miners are squeezed from multiple sides. They are exposed to metal prices, energy costs, financing costs, labor costs, and broad equity risk. When silver falls, oil stays expensive, yields rise, and investors de-risk, miners get hit hard. But again, mining stocks are not the same thing as physical silver. Mining shares can collapse on macro pressure even when the physical market remains tight. Now look at COMEX. Registered silver, the deliverable category, is sitting around 79.88 million ounces. The delivery coverage ratio is around 13.4%, marking the 7th consecutive month below the 15% stress threshold. That is important because COMEX is not just about price. It is about deliverable supply. If a market is running with paper obligations that are large compared with registered deliverable metal, then the system becomes more sensitive to delivery pressure. The Silver Institute and Metals Focus World Silver Survey 2026 projects a global silver supply deficit of 46.3 million ounces for 2026. That would be the 6th consecutive annual deficit. Total supply is expected to contract by about 2%, while industrial demand is expected to remain above 650 million ounces annually. That is the structural bull case. The world keeps using silver. Industrial demand remains high. Supply is not expanding fast enough. Deficits keep appearing. Registered deliverable inventory remains tight. London vault holdings have been draining for years. And yet paper silver can still crash in one day because futures markets, ETFs, leverage, and macro positioning can overwhelm the short-term tape. That is exactly what happened Friday. The ETF picture also shows a split. The iShares Silver Trust has seen persistent outflows through the first quarter of 2026, including a major single-day redemption during February turbulence. That shows paper side selling pressure. But the Sprott Physical Silver Trust, which holds fully allocated London Good Delivery silver in Royal Canadian Mint vaults, has continued to see institutional accumulation through the first quarter. That tells us the paper side and the allocated physical side are not sending the same message. The paper market is volatile. The physical market remains tight. Now zoom back out to the macro tape. The U.S. 10-year Treasury yield closed Friday at 4.59%, the highest reading since February 2025. The 2-year Treasury yield closed near 4.09%, also the highest since February 2025. Over the last 4 weeks, the 10-year yield gained more than 22 basis points. The U.S. dollar index is trading near 98.5, firming into the inflation data and the hawkish Fed repricing. Retail sales rose 0.5% month over month in April, slightly below expectations and down from March's stronger reading. Furniture stores fell 2%. Car dealerships fell 0.5%. Department stores fell 3.2%. Clothing stores fell 1.5%. The retail control group, the cleaner input for GDP, rose 0.46%, which was better than expectations. So the consumer is not dead, but the consumer is under pressure. Initial jobless claims came in at 211,000, while continuing claims rose to 1.782 million. That is not recession panic yet, but it does show some softening under the surface. Then came the University of Michigan Consumer Sentiment reading. The preliminary May reading printed at 48.2, the lowest level ever recorded since the survey began in 1952. About 1/3 of consumers cited gasoline prices, and roughly 30% cited tariffs. Year-ahead inflation expectations are sitting at 4.5%, while long-run inflation expectations are at 3.4%. That is a dangerous mix. Consumers are historically worried. Inflation expectations are rising. Energy is expensive. The labor market is not broken enough to force Fed easing. Yields are rising. The dollar is firm, and the Fed may be turning even more hawkish. That entire setup pressures silver in the short run. Now let's be fair and give the bearish case properly. Silver at 77.52 is still far below the January high near 121.67. Analyst consensus for the 2026 average silver price is around 79.50, which is close to current spot. That means, from one angle, silver may not look cheap after such a huge run. Photovoltaic silver demand is also becoming a concern. Solar manufacturers are reducing silver content per cell. Some companies are moving toward copper paste and silver-free technologies. Photovoltaic silver demand fell in 2025 and is forecast to fall further in 2026. That matters because solar has been one of the strongest industrial demand stories for silver. If solar demand weakens or thrifting accelerates, part of the industrial bull case becomes less aggressive. There is also a technical risk. Silver's 2026 low was near 67.90 on March 20th. If silver breaks below the $70 support region, the market could retest the high 60s before stronger buyers return. The Fed is another headwind. If there are no rate cuts in 2026 and a rate hike becomes more likely by December, that is not friendly for zero-yield metals. The 10-year yield at 4.59% and a firm dollar near 98.5 both create opportunity cost pressure against bullion. The June FOMC meeting is now a major risk event. If the new dot plot removes all remaining rate cut expectations, silver could remain under pressure longer than bulls want to admit. There are also ETF outflows, Indian tariff hikes, weaker retail categories, record low consumer sentiment, and possible industrial demand destruction in appliances and electronics. So the bear case is real. This desk is not hiding it. But the structural case is also real. The COMEX registered inventory remains tight. The delivery coverage ratio remains below the stress threshold. The London silver pool has drained heavily from its 2021 peak. The Silver Institute is projecting a sixth consecutive annual deficit. Industrial demand remains high. Supply is forecast to contract. And physical allocation demand has not disappeared. That is why Friday's move is so important. It did not prove the silver thesis was dead. It proved that paper silver can still be violently repriced when macro pressure hits. Here's the board as of Saturday morning, May 16th. Spot silver is around 77.52. Spot gold is around 45.64. The gold to silver ratio is around 58.9. WTI July futures are around 113.50. Brent crude is around 116. The dollar index is near 98.5. The 10-year Treasury yield is 4.59%. The 2-year Treasury yield is 4.09%. April CPI is 3.8% year over year. Core CPI is 2.8%. April PPI is 1.4% month over month and 6.0% year over year. Core PPI is 1.0% month over month and 5.2% year over year. Retail sales rose around 5%. Jobless claims came in at 211,000. Continuing claims rose to 1.782 million. Consumer sentiment printed 48.2, the lowest reading on record. Year-ahead inflation expectations are 4.5%. Long-run inflation expectations are 3.4%. FedWatch shows almost no chance of a 2026 rate cut and around a 50% probability of a rate hike by December. Kevin Warsh is now Fed chair. Jerome Powell remains on the Board of Governors through January 2028. The first Warsh-led FOMC meeting is June 16th and 17th. COMEX registered silver is around 79.88 million ounces. The COMEX delivery coverage ratio is 13.4%. LBMA Loco London silver holdings are around 27,454 tons, equal to roughly 882.66 million ounces. The Silver Institute projects a 46.3 million ounce deficit for 2026. The Strait of Hormuz remains operationally restricted. Saudi oil output is at its lowest level since 1990. The Trump-Xi summit ended with no major breakthrough on Iran, Taiwan, rare earths, or semiconductor flows. Fresnillo fell roughly 9% on Friday. The mining complex was hit hard. iShares Silver Trust has seen major paper side outflows. Sprott Physical Silver Trust continues to accumulate allocated physical silver. India doubled gold and silver import tariffs from 6% to 15%. That is the real map. So what does it mean? It means Friday's silver crash was not random. It was the result of hot inflation, rising yields, a stronger dollar, hawkish Fed repricing, energy shock pressure, geopolitical uncertainty, ETF liquidation, and a sudden unwind in a market that had already run extremely hard. But it also means the physical silver story is not broken. A price crash can happen in the paper market without fixing the inventory problem. A sell-off can hit mining shares without refilling London vaults. A futures liquidation can crush spot price without changing the 6-year deficit trend. A stronger dollar can hurt silver today without solving the supply-demand imbalance underneath. That is the tension. Short-term pressure. Long-term stress still building. And that is why investors need discipline right now. This is not the time to chase noise. It is not the time to panic because of one candle. It is not the time to ignore risk either. The right move is to understand the layers. The paper market is reacting to the Fed. The physical market is reacting to supply. The energy market is reacting to war. The consumer is reacting to inflation. The bond market is reacting to higher for longer policy. And silver is sitting directly in the middle of all of it. Before I sign off, one more time, if this research helps you, please consider supporting the source code on Patreon. The link is in the description. It is $20 a month. It is a humble ask, not a demand. If you can help, you keep this desk alive. If you cannot, the work stays free here. Every data point mentioned tonight is verifiable. Pull the sources yourself. Check the precious metals reports. Check the BLS CPI and PPI releases. Check FedWatch. Check the Treasury yield snapshots. Check the LBMA vault data. Check the Silver Institute report. Check the COMEX inventory numbers. Check the oil market reports. Check the consumer sentiment data. Check the retail sales release. That is the entire point of the source code. Do not trust noise. Verify the structure. Drop the source code in the comments if tonight's breakdown gave you a clearer read on what really happened in silver. The hottest wholesale inflation print in years hit the tape. A new hawkish Fed chair took power. The Trump C summit delivered no major relief. The Strait of Hormuz remains restricted. Oil is still feeding inflation. Saudi output is at its lowest level since 1990. Mining stocks were hammered. COMEX coverage remains stressed. The Silver Institute still projects another deficit. London Vault silver remains far below its 2021 peak. Friday's 10% silver crash did not erase those facts. It exposed the pressure between paper and physical all over again. Pay attention. Invest with logic, never with noise. This is OG John AG, and this is the source code. OG out.